Okay, get this. According to Project Equity, baby boomers own something like 2.3 million businesses. And the forecasts, they predict maybe 6 out of 10 of those owners are planning to sell within the next decade.
Wow, that's a huge number, a massive wave coming.
Exactly.
Okay.
And you hear that, you think big payday, right? I mean, it's the finish line after years, maybe decades, of just pouring everything, your time, your money, your sanity, into building something real.
The culmination of all that effort.
But here's the thing, the reality check that often hits way too late. Taxes.
Yeah.
What actually happens with the tax man when you finally cash out?
Right, because that dream number, that headline price, it can shrink pretty dramatically once Uncle Sam takes his cut. It's not just a small slice either. We're talking potentially millions depending on the deal.
And that's exactly why we're doing this deep dive today. We've got this pile of source material, you, our listeners, provided stuff from the SBA, IRS info via places like Investopedia and Smith Anderson, insights from accounting firms like Conling & Company, Wolters Kluwer.
Yeah, and financial guidance, too, from U.S. Bank, Forbes. It's a good mix.
It is. So our mission here is pretty clear. Cut through all that complexity, all the jargon, and pull out the really crucial bits of information. We want to help you understand the main tax implications and, maybe more importantly, the strategies you might have when selling your business in the U.S.
Basically, we want you to keep more of the value you've worked so hard to create. Think of this as your essential pre-sale tax briefing.
Love it. So we'll look at what drives that tax bill, the big choice between how you structure the sale.
Asset sale versus stock sale, yeah. That's fundamental.
How your business type, LLC, S-Corp, C-Corp, changes things.
Oh, definitely. Each has its own wrinkles.
And then get into some specific strategies the sources mentioned for hopefully lowering that tax hit.
Sounds like a plan. Let's get into it.
Okay, so kicking off with that core challenge, big payday potentially, big tax.
It really is the central tension, isn't it? You're excited, you should be. Building and selling a business is a massive achievement. But every single source we looked at hammers this point home. Taxes are the big, often underestimated factor that can take a huge bite out of your final proceeds.
Yeah, U.S. Bank, Forbes, they list things like capital gains tax, ordinary income tax.
Medicare taxes, sometimes even estate taxes can come into play. It all adds up and can seriously erode the value you walk away with.
So it sounds like if you don't plan for this properly, it could be, financially painful.
It absolutely can be. And this leads directly to the number one takeaway echoed across all these sources. You have got to plan early, like really early.
Not something you figure out when you're at the closing table.
Definitely not. The SBA source, quoting Barbara Weltman, says it perfectly. The more planning you do ahead of time, the more tax efficient the sale of your business can be. Ideally, tax planning for the exit starts years before you even think about selling.
So tax planning isn't just, compliance, filling out the forms right. It's actually a strategic move to minimize what you owe and maximize what you keep.
Exactly. It's about knowing the rules before you even start negotiating the deal. It lets you structure things in a way that legally reduces your taxes, maybe taking advantage of deductions or deferral strategies the code allows. It's really proactive wealth preservation.
Okay, so speaking of planning and structuring, the sources, like Conling & Company, say one of the very first and maybe biggest decisions is the structure of the sale itself.
Yep, this is ground zero. It's the fundamental choice. Are you selling the company's assets, or are you selling the stock of the company, or, the membership interests if it's an LLC or a partnership?
And this choice isn't just legal paperwork. It changes everything tax-wise.
Fundamentally, it dictates what the buyer actually buys, who keeps the liabilities, and crucially for our discussion, how the money you receive gets taxed.
All right, let's break that down. First up, an asset sale. What does that mean for the seller's taxes?
Okay, so in an asset sale, the buyer is essentially buying a list of specific things the business owns. Think tangible stuff like equipment, inventory, maybe the building, and intangible stuff like patents, customer lists, brand name, and the big one, goodwill.
But they're not buying the actual legal company, the C-Corp or LLC wrapper.
Generally, no. The legal entity itself, the shell, initially stays with you, the seller. And usually, so do the company's liabilities.
Ah, okay. So the buyer gets the good stuff, leaves the potential baggage behind. I can see why buyers like that.
Exactly. Buyers often prefer asset sales for that reason. They pick the assets they want, and they typically don't inherit the seller's known or unknown liabilities. Plus, there's another huge advantage for the buyer.
The step up in basis.
You got it. The buyer gets to record the assets they bought on their books at the price they paid. This means they can start depreciating or amortizing those assets from that higher value, which translates into bigger tax deductions for them down the road compared to carrying over your old, lower basis.
So, good for the buyer's future taxes. But what about the seller? You said it's more complicated.
It is, because the tax treatment for the seller depends entirely on what kind of asset generated the gain. If you allocate proceeds to, say, goodwill, that's usually taxed at the lower capital gains rates. Good outcome.
Good.
But proceeds allocated to other things can be taxed very differently. Inventory, for example, that's ordinary income. And then there's the one you mentioned earlier, depreciation recapture.
Right, the tax clawback.
Yeah. If you sell an asset, like a piece of machinery, for more than its depreciated value on your books, the IRS essentially says, hey, those depreciation deductions you took over the years, turns out you didn't need them all because the asset held its value. So they recapture that benefit.
And how do they recapture it?
By taxing the gain up to the amount of depreciation you took at ordinary income tax rates, not capital gains rates. Ordinary rates, which can be much higher, potentially up to 37%. Even real estate faces recapture, though the rate is capped differently there. We'll dig into the specifics later, but it's a potential shock if you haven't planned for it.
Okay, so asset sale. Buyer likes it for liability protection and basis step up. Seller faces complex, potentially higher taxes due to blended rates and recapture. What about the alternative, a stock sale?
In a stock sale, it's much simpler conceptually. The buyer acquires the actual ownership shares of the corporation or the membership interests of the LLC. The entire business assets, liabilities, everything transfers to the buyer within that existing legal structure.
The whole kit and caboodle, including all the liabilities, even ones the buyer might not know about.
Exactly. And that's the big downside for the buyer, as Conley points out. They inherit the company's entire history, warts and all. This risk often means buyers will push for a lower price in a stock sale or demand really strong protections in the agreement, like indemnification clauses.
Makes sense. So what's the draw for the seller then? Why would they prefer it?
Taxes. Generally, sellers much prefer stock sales for tax reasons. When you sell stock, your entire gain is typically treated as a capital gain. Assuming you've held the stock long enough, that means it's taxed at the lower long-term capital gains rates. It's simpler, cleaner, and usually results in a significantly lower tax bill compared to an asset sale with its ordinary income components.
And the buyer doesn't get that nice basis step up on the assets.
Not automatically, no. In a straightforward stock sale, the buyer just gets basis in the stock they bought. The assets inside the company keep their old, low basis from your books. That's a major disadvantage for the buyer. No juicy future depreciation deductions based on the purchase price.
But you mentioned there are ways around that, like special elections?
Yeah. The sources mention things like the Section 338 election. This is complex stuff, but essentially it allows a deal structured legally as a stock sale to be treated like an asset sale purely for tax purposes. So the buyer gets the basis step up they want while it's still legally a stock transfer. These are definitely get professional help scenarios.
Got it. So asset versus stock. It's this fundamental tug of war in the negotiation, with buyer and seller having opposite tax preferences.
Absolutely. Seller wants stock sale simplicity and capital gains. Buyer wants asset sale basis step up and liability shield. It often comes down to price. A seller might take a slightly lower headline number in a stock sale because their after-tax proceeds could still be higher. Always got to run the numbers on an after-tax basis.
And you said if it is an asset sale, that allocation of the purchase price is super important.
Oh, absolute critical. Because you sold a mix of assets, you and the buyer must agree on how the total purchase price gets divided up among them. The IRS requires this on Form 8594, which lays out 7 specific classes of assets, starting with cash and ending with goodwill and going concern value in Class 7.
And this isn't just an accounting exercise. It directly hits both parties' tax bills.
Directly. For you, the seller, allocating more money to assets like goodwill, Class 7, means more capital gains tax. Allocating more to, say, inventory or equipment subject to recapture means more ordinary income tax. For the buyer, allocating more to assets they can depreciate quickly, like equipment, means bigger deductions sooner.
So classic negotiation conflict.
Yeah.
Seller wants high value on goodwill, buyer wants high value on machinery.
You nailed it. And the key thing is the IRS requires both the buyer and the seller to file Form 8594 with the exact same allocation numbers. If they don't match, it's a huge red flag. So hammering out that allocation schedule is a really crucial and sometimes contentious part of finalizing an asset sale deal.
Wow. Okay, so sales structure is huge. Allocation is key in asset sales. What about the type of business entity itself? Does it matter if you're selling a C-Corp versus, say, an LLC?
Oh, it matters immensely. Your entity structure is like another layer on top of the asset stock decision, and it profoundly impacts how the sale proceeds are taxed.
Okay, let's walk through the main ones the sources cover. Simplest first, the sole proprietorship.
Right. Wolters Kluwer explains this is just one person owning an unincorporated business. Legally, there's no separation between the owner and the business. Your personal assets and debts are mixed with the business's assets and debts.
So when you sell the business, it's taxed as if you just sold all the individual pieces, like an asset sale.
Pretty much, yeah. The SBA source confirms this. You have to allocate the sale price across the different business assets, equipment, goodwill, etc. Some generate capital gains, others ordinary income like inventory or that recapture piece. You'd still use that Form 8594 logic for allocation.
Filing seems simple enough, just Schedule C on your personal 1040 tax return. But that big drawback is the liability exposure.
That's the major risk. If the business gets sued or racks up debt, your personal assets, your house, your savings are potentially on the line. There's no protective wall.
Okay, which naturally leads to the single-member LLC, SMLLC. Wolters Kluwer draws a direct comparison here. What's the key difference?
Liability protection. That's the headline difference Wolters Kluwer emphasizes. An SMLLC is a separate legal entity. It creates a shield separating your personal assets from the business's debts and obligations. Huge advantage, especially if your business has some risk or you have significant personal assets you want to protect.
But tax-wise, isn't it often treated just like a sole proprietorship by default?
Yes, that's the default federal tax treatment. The IRS calls it a disregarded entity, meaning for tax purposes, it's ignored, and all the income and expenses flow through to your personal tax return on Schedule C, just like a sole prop. Profit is taxed whether you take it out or not.
So basically the same tax filing, but with that critical legal shield.
That's the beauty of it. By default, you get the liability protection without corporate tax complexity. But, and this is a key advantage over a sole prop, an SMLLC owner can choose to have the LLC taxed differently. You can file an election to be taxed as a C corporation or an S corporation if that offers better tax outcomes for your situation. A sole proprietor can't do that.
Interesting flexibility. So if an SMLLC sells its assets and hasn't elected corporate status, it's taxed like a sole prop asset sale, asset by asset, potential recapture. But the owner's personal assets are generally safe.
Correct. Assuming you've maintained the separation and haven't commingled funds and all, that the LLC structure should protect your personal assets while the default tax treatment remains simple.
Okay, what about partnerships and multi-member LLCs? Conley talks about these.
Right. If you sell your interest in a partnership or an LLC taxed as a partnership, it's generally treated like selling a capital asset. So you'd expect the gain or loss to be capital gain or loss.
Sounds straightforward.
Of course.
But I sense a but coming. Is there a catch specific to partnerships?
There is, and it's a big one. The sources call it the hot assets rule. Even though you're selling your partnership interest, which is a capital asset, a portion of your gain must be reclassified and taxed as ordinary income if it's attributable to the partnership's share of certain underlying assets.
Hot assets. What kind of assets trigger this?
Primarily unrealized receivables, money owed for services rendered or goods delivered but not yet included in income, and inventory items. So part of your seemingly capital gain gets taxed at potentially much higher ordinary income rates.
Ouch. Another potential tax surprise, if you're not ready for it, requires careful calculation.
Definitely requires careful analysis of the underlying assets and proper allocation. And partnerships and LLCs have another unique tax quirk the Investopedia source details: phantom income.
Phantom income.
Sounds spooky. What is it?
It's income you're taxed on even though you haven't actually received the cash. It feels phantom because the cash isn't in your bank account, but the tax bill is real.
How does that happen in a partnership or LLC?
Because these are pass-through entities. The business's profit is calculated, and your share of that profit is reported to you on a Schedule K-1. You owe tax on that allocated profit, regardless of whether the business actually distributes the cash to you or decides to keep it and reinvest it.
So the business could make a profit, use it to buy new equipment, give you zero cash, but you still owe tax on your share of that profit.
Exactly. Investopedia gives that classic example. $100 K profit, you're a 10% partner, you get a K1 showing $10 income. You pay tax on $10 K even if the partnership distributed nothing. Non-cash benefits, like use of a company car, can also create phantom income.
That's a potential nightmare tax due, no cash to pay it. How do partners protect themselves?
The key protection, as Investopedia explains, is having a tax distribution clause in the partnership or LLC operating agreement. This clause legally requires the business to distribute enough cash to the owners each year, specifically to cover the taxes owed on their allocated share of the income.
So it forces a distribution just for tax payments, even if other distributions aren't happening.
Precisely. Investopedia suggests clauses mandating distributions based on a set tax rate, maybe 40% of taxable income allocated, to ensure owners have the cash flow to handle their tax obligations. It's absolutely critical for anyone in a partnership or multi-member LLC.
Essential protection. Okay, let's move to C corporations. What's the big tax headline here, especially if they do an asset sale?
Double taxation. That's the major risk for C-Corp, as highlighted by Conley and the SBA.
Paying tax twice on the same profit. How does that work in a sale?
If a C-Corp sells its assets and makes a profit, that profit is taxed first at the corporate level. The C-Corp pays corporate income tax. Then, if the corporation distributes the remaining cash from the sale to its shareholders, those shareholders pay tax again on that distribution, usually as a dividend or capital gain on their personal returns.
That sounds like a huge tax haircut for the owners.
It can be incredibly inefficient. And it's the main reason why C-Corp owners almost always strongly prefer to structure the deal as a stock sale.
Because in a stock sale, only the shareholders pay tax.
Right. In a stock sale, the shareholders sell their stock and pay tax, usually capital gains, on their individual profit. The corporation itself isn't selling assets, so that first layer of corporate tax on the gain is avoided. Much better outcome for the sellers.
Okay, C-Corp aim for stock sales. What about S corporations? The SBA source mentioned some advantages here.
S-Corp are also pass-through entities, like partnerships. So income and losses generally flow directly to the shareholders' personal returns without being taxed at the corporate level first. In an asset sale, this means an S-Corp usually avoids that double taxation problem that plagues C-Corp. The gain just passes through.
So generally no corporate level tax in an asset sale. That's a big plus.
Generally, yes. There is one key exception, though,
Oh.
the built-in gains tax.
Oh.
If a company was a C-Corp, then elected S-Corp status, and then sells assets within a certain period, usually 5 years, that had appreciated before the S election, well, that built-in appreciation can still be taxed at the corporate level, so history matters.
Got it. And you mentioned that 3.8% Medicare tax earlier, the net investment income tax. The SBA source said S-Corp might have an advantage.
Yes, this is interesting. For an S-Corp owner who actively participates in the business, the gain from selling their S-Corp stock is typically not subject to that 3.8% IIT. However, gain from selling C-Corp stock usually is subject to that tax.
So potentially another 3.8% saved if you're an active S-Corp owner selling stock compared to a C-Corp owner?
Potentially, yes. The SBA highlights this, and while you can convert a C-Corp to an S-Corp before a sale, you have to watch out for that built-in gains tax. Also, S-Corp can use ESOPs, but that special tax deferral benefit for C-Corp owners selling to an ESOP doesn't usually apply to S-Corp owners.
Man, just going through these entity types makes it so clear how critical that initial structure choice is. Asset versus stock, allocation, and then the entity itself. These are the absolute foundations for figuring out the tax impact.
They really are. And you need to understand these foundations before you can even start thinking about specific tax-saving strategies.
Right. So let's pivot to those strategies. Beyond just choosing the right structure, what specific tactics do sources like Forbes and the SBA suggest sellers can use to try and minimize that tax bill?
Okay, there are quite a few options, and the best fit really depends on your specific situation. A very common one is the installment sale. Both Forbes and the SBA discuss this.
Sounds like getting paid over time. Pay tax as you get the cash.
That's the basic idea. Under the tax code, specifically Section 453, if you receive at least one payment for your business after the tax year of the sale, the deal is automatically treated as an installment sale unless you choose not to use it.
And the benefit is spreading out the tax.
Exactly. You recognize the taxable gain proportionally over the years you receive payments. It doesn't necessarily lower your total tax, but it defers it. You calculate a gross profit ratio, basically your total profit, divided by the total selling price, and apply that ratio to each payment received to figure out the taxable gain for that year.
Does it work for selling anything in the business?
Not everything. You generally can't use the installment method for selling inventory or certain types of receivables. And of course, the big non-tax risk is that the buyer might default on future payments.
Makes sense. Okay, what about selling to your employees using an ESOP, an employee stock ownership plan?
Yeah, the SBA highlights ESOPs as a potentially powerful strategy, especially for C corporations. It involves setting up a trust for the employees, and the owner sells their shares to that trust.
So the employees effectively become the owners over time.
That's the goal. For the selling owner, it can provide a ready buyer, often at a fair market price, and they receive cash from the ESOP trust. The big tax win, specifically for C corporation owners under Section 1042, is that if they sell a certain percentage of their stock, at least 30% to the ESOP, and reinvest the proceeds into certain types of stocks and bonds, qualified replacement property, within a set time frame, they can defer paying capital gains tax on that sale.
Defer potentially indefinitely.
Potentially until they sell the replacement securities, or even potentially eliminate it if held until death due to the step-up in basis rules. It's a major tax advantage for C-Corp owners looking for an exit.
But not typically for S-Corp owners.
Right. The SBA notes that specific Section 142 deferral generally doesn't apply to S-Corp owners selling to an ESOP, even though S-Corp can set up ESOPs.
Okay. Another strategy from Forbes. Reinvesting gains in opportunity zones. Section 1400 zones.
Yes, this is all about deferring capital gains. If you have a capital gain from selling your business or really any capital asset, you can potentially defer the tax on that gain by reinvesting it into a qualified opportunity fund, or QOF, within 180 days of the sale. These funds invest in economically distressed communities designated as opportunity zones.
So you postpone the tax. For how long?
You defer paying tax on that original reinvested gain until December 31st, 2026, or until you sell your QOF investment, whichever comes first. But there's a kicker.
A bonus.
Yeah, a potentially big one. If you hold your investment in the QOF for at least 10 years, any future appreciation on that QOF investment itself can be completely tax-free when you sell it. So deferral now, potential tax-free growth later. You only need to reinvest the gain portion you want to defer, not the entire proceeds.
That sounds pretty attractive. What about the classic 1031 exchange?
Forbes mentions this too. A 1031 exchange is specifically for deferring capital gains tax on real estate. If your business owns real property, like its building or land, you can sell the business but structure the real estate part of the sale as a 1031 exchange.
Meaning you roll the proceeds from selling the business's real estate into buying another like-kind investment property.
Exactly. Within strict timelines, of course, it allows you to defer the capital gains tax on the real estate component, essentially keeping that part of your investment working for you tax-deferred, even as you exit the operating business.
Useful if real estate is a big part of the business value. Now, Forbes also talked about qualified small business stock, QSBS. Section 1202. This one sounded potentially huge.
It is, potentially. QSBS rules can allow for up to a 100% exclusion of federal and capital gains tax when you sell the stock. But, and these are big buts, it only applies to stock in C corporations, and there are very strict requirements.
100% tax-free gain. What's the catch?
Several big ones. You generally have to have held the stock for more than 5 years. The corporation must have been a C-Corp for substantially all of your holding period. And critically, the corporation must have had gross assets of $50 million or less at all times before and immediately after the stock was issued. Plus, it has to be an active business in certain qualifying industries.
So lots of hurdles to clear.
Definitely. And the amount of gain eligible for exclusion is capped, typically at the greater of $10 million or 10 times your basis in the stock per taxpayer per company. But if you qualify, it's an absolute home run tax-wise. Every C-Corp owner planning an exit needs to investigate if their stock could possibly be QSBS.
No kidding. Okay, we also touched on those IRC 33810 elections and hybrid structures when we talked asset versus stock. Forbes and Conley bring these up as strategic options too.
Right. These are definitely in the advanced playbook category. As we discussed, a 338 election lets a buyer and seller agree to treat a stock sale of an S-Corp or an affiliated C-Corp subsidiary as an asset sale just for tax purposes.
So the buyer gets their desired basis step up, even though legally it's a stock deal.
Correct. It bridges that gap. But it's complex. It requires both parties to agree, and it can change the tax consequences for the seller, potentially triggering ordinary income recapture they might have otherwise avoided in a pure stock sale. You have to carefully model the numbers, including any price adjustment the buyer offers for the tax benefit, to see if it makes sense overall for the seller. Conley mentions it can even involve related corporate restructurings.
Yeah, definitely sounds like you need top-tier advisors for that one.
Absolutely. These hybrid approaches are for sophisticated transactions and demand expert legal and tax guidance.
Forbes also briefly mentioned charitable planning as another potential strategy area.
Yeah. The sources didn't go deep here, but contributing some of your business stock or interest to a charity or a specialized trust before or as part of the sale can sometimes generate significant tax benefits, like a charitable deduction, while also potentially reducing capital gains tax and fulfilling philanthropic goals. Again, complex and needs specialized advice.
Wow, okay. That's quite a menu of potential strategies. Installment sales, ESOPs, opportunity zones, 1031s, QSBS, complex elections, even charity.
It really shows there's no single magic bullet. The right strategy or combination of strategies totally depends on your specific business, your goals, the deal structure, everything.
All right, let's shift to something the Smith Anderson source really dove into, earnouts. They call them contingent payment sales.
Yeah.
This section looked, let's just say, dense.
Yeah. Earnouts are notoriously complex from a tax standpoint, and they're pretty common in deals. An earnout is basically where part of the purchase price isn't paid upfront, it's paid later if the business hits certain performance targets after the sale.
So the total price isn't fixed when the deal closes. And Smith Anderson warned it's not as simple as just paying tax if and when you get the earnout money.
Exactly right. Because the total selling price is uncertain or contingent, special tax rules kick in for how you recover your cost basis against those future uncertain payments. It's a specific type of installment sale, but the basis allocation is the tricky part.
Okay, let's try to unpack the core ideas from the source without getting lost in every calculation detail. The rules seem to hinge on whether the earnout has a cap or a fixed time limit.
Correct. Rule number 1 applies if there is a maximum selling price, meaning the earnout is capped, you might get up to $6 million extra, but no more.
So if there's a ceiling on the potential payout.
Yes. In that case, the rule says, for your initial tax calculation, you have to assume you'll hit all the targets and receive the absolute maximum capped price. You use that maximum potential price to figure out your gross profit percentage for the installment sale.
So you calculate your gain up front based on the best case scenario.
For determining the ratio, yes. Then you apply that ratio to the payments as you receive them. Smith Anderson's example 2 showed this calculating the gain on the initial payment based on that maximum possible total price.
But what if you don't hit the targets, like in their example 3, where one of the earnout payments doesn't happen?
Good question. If the maximum potential price becomes impossible to receive because a contingency failed, you then have to recalculate the total selling price and the gross profit. This can change the amount of gain you recognize on any remaining future payments. It's a recalculation and reallocation process for the later payments.
Okay, that's rule 1 for capped earnouts. What's rule number 2? For when there's no maximum price, but the earnout payments are only due over a fixed period, like for the next 5 years.
Right, so the potential amount is unlimited, but the time frame isn't. Here, the basis allocation rule changes completely. You take your entire cost basis in the business sold, and you allocate it equally over the fixed number of years during which payments might be received. Smith Anderson's example 4 did this, splitting the basis evenly over the 5 potential payment years.
Okay, so you get a fixed slice of basis assigned to each potential payment year. How does the tax work then?
Each year, you compare the earnout payment you actually receive, if any, to the basis allocated to that year, plus any unused basis carried forward from previous years. If the payment is more than the basis allocated, the excess is taxable gain for that year. If the payment is less than the basis allocated, you don't recognize a gain. Instead, the payment is treated as recovery of basis, and the leftover unused basis gets carried forward to the next year.
So basis can shift forward if payments are low early on? What's the critical thing that happens in the last year of the fixed term?
This is the key difference and potential downside compared to a capped earnout. In the final year of the fixed term, if the payment received is less than the basis allocated for that year, plus all the carried forward basis, you finally get to recognize a loss equal to that unrecovered basis.
So you could have recognized gains in early years, paid tax, and then end up with a loss in the final year.
Exactly. And that loss is typically a capital loss. Capital losses have limitations. You can use them to offset capital gains, but their deductibility against ordinary income is limited each year. You generally can't carry a capital loss back to offset gains from prior years of the earnout.
Which leads to Smith Anderson's main strategic point about capping.
Right. They argue that putting a reasonable cap on the earnout, even if it feels like limiting your upside, can often be better for the seller from a tax perspective.
Why? How does the cap help?
Because with a cap, Rule 1, you effectively accelerate your basis recovery against the earlier payments. Remember, you calculate the initial ratio assuming the max payout. This usually means more of your basis offsets the initial closing payment and early earnout payments. While it might result in slightly more taxable gain up front, it makes it much less likely you'll end up with a large chunk of unrecovered basis, and thus a potentially less useful capital loss at the very end of the earnout period. Without a cap, Rule 2, basis is spread thin over the years, increasing the risk of that final year loss if targets aren't met later on.
So capping trades may be slightly higher tax early for potentially avoiding a less useful loss later. That's a really nuanced negotiation point.
It absolutely is. It requires forecasting, understanding the basis recovery rules, and balancing potential upside versus tax efficiency. It really highlights how intricate earnout taxation is.
No kidding. It's definitely not intuitive. Okay, you mentioned we'd circle back to depreciation recapture in more detail. The Investopedia source had some good examples here. Let's hit that tax clawback properly.
Right. Depreciation recapture. The core idea is fairness from the IRS's perspective. You took tax deductions for depreciation over the years, assuming an asset was losing value. If you then sell it for more than its depreciated book value, its adjusted basis, the IRS says, hold on, that asset didn't lose as much value as your deductions implied. We need to recapture some of that tax benefit you got.
So it's reversing some of the prior tax savings from depreciation.
Essentially, yes. When you sell a depreciable asset for more than its adjusted basis, the portion of your gain that's equal to the depreciation you previously claimed is tagged as recapture and taxed differently than regular capital gains.
Investopedia's pizza oven example was pretty clear.
Yeah.
Buy for $50K, take $30 rate depreciation, so basis is $20. Sell for $35K.
Yeah.
The $50 gain, $35K minus $20K, is all considered depreciation recapture.
Exactly. Because the entire gain, $15K, is less than or equal to the depreciation previously taken, $30. And you report this on IRS Form 4797, Sale of Business Property.
Now, the crucial part is how that recaptured gain is taxed. You said it depends on the type of asset.
Correct. The tax code splits assets mainly into two camps here, Section 1245 and Section 1250.
Okay, Section 1245, what falls under that?
Section 1245 covers most types of tangible personal property used in a business. Think machinery, equipment, furniture, vehicles, things like that. For these assets, the depreciation recapture amount is taxed at your ordinary income tax rates.
Ordinary income rates, so potentially up to that 37% maximum federal rate plus state taxes.
That's right. It's taxed just like salary or regular business income, not the preferential capital gains rates. This is where the clawback really bites.
So on that $15K gain from the pizza oven, if it's Section 1245 property, you're paying tax at your highest marginal rate.
Correct. Now, if you sold that oven for even more, say $60K, remember, original cost was $50K, depreciation was $30K, basis is $20K, the total gain is $40K, $60K minus $20K. The first $30K of that gain up to the total depreciation taken is Section 1245 recapture, taxed at ordinary rates. The remaining $10 of gain, $60K sale price minus $50K original cost, is treated as capital gain, likely long-term capital gain taxed at the lower rates.
Okay, so recapture applies up to the amount of depreciation taxed as ordinary income. Gain above the original cost is capital gain. Got it. What about Section 1250 assets?
Section 1250 primarily deals with real property buildings and their structural components. The recapture rules here are generally more taxpayer-friendly, especially if you use the straight-line method of depreciation, which is standard for real estate.
More friendly how?
For Section 1250, property depreciated using straight line, the gain attributable to that depreciation isn't taxed at your full ordinary income rate. Instead, it's called unrecaptured Section 1250 gain, and it's subject to a maximum federal tax rate of 25%.
So not the lowest capital gains rate, but capped at 25%, which is usually much better than the top ordinary income rates.
Exactly. And just like with 1245 property, any gain above the property's original purchase price still qualifies for the standard long-term capital gains rates, often 0%, 15%, or 20%, depending on your income.
Investopedia had that apartment building example.
Yeah.
Bought for $500, took $181K depreciation, sold for $700K. How does that break down?
Right. The first $181K of gain, equal to the straight-line depreciation taken, is unrecaptured Section 1250 gain, taxed at a maximum rate of 25%. The remaining $200K of gain, $700 sale price minus $500K original cost, is regular long-term capital gain, taxed at the lower capital gains rates, say 15%.
That's a huge difference. Recapture on equipment hits much harder tax-wise than recapture on real estate.
It really does, and this is why, especially in an asset sale, understanding which assets fall under 1245 versus 1250 and how much depreciation has been taken on each is absolutely critical for negotiating that purchase price allocation. You might be willing to allocate long value to a piece of fully depreciated machinery if you know the entire gain will be ordinary income recapture.
Definitely something to factor into the negotiation strategy. Okay, this deep dive has covered so much ground. The asset versus stock choice, entity impacts, strategies, earnout nightmares, recapture rules, it's undeniably complex.
It is profoundly complex. And if there's one thread woven through all the sources we looked at, it's the absolute non-negotiable need for expert guidance.
Yeah, that point came up again and again. Not just a suggestion, but basically a command. Don't do this alone.
It's truly the ultimate takeaway. Selling a business is described in these sources as a highly complex matter, legally and especially tax-wise. Trying to navigate this solo is just asking for trouble, potentially very expensive trouble. You need a team.
And by team, we mean primarily an experienced M&A attorney and a CPA who really knows the ins and outs of business sales.
Minimum. Conley & Company, U.S. Bank, Forbes, SBA, Smith Anderson, they all say it. These pros help you model the tax outcomes of different structures, analyze your specific entity situation, understand and negotiate those tricky deal points like allocation and earnouts, figure out which strategies like QSBS or opportunity zones might apply, ensure you're compliant. Basically, they help you make informed choices to maximize what you actually keep.
The cost of getting good advice seems tiny compared to the potential cost of getting it wrong. Unexpected taxes, missed strategies, legal issues.
No question. Even deals that seem simple on the surface can have hidden tax traps or opportunities. Only experts who deal with this constantly can reliably spot them. Planning isn't optional, and professional guidance is absolutely indispensable.
All right, well, this has certainly been a journey through the maze of U.S. tax implications when selling a business. We've hit the big stuff: asset versus stock sales, how your entity choice matters, the range of tax-saving strategies, the surprising twists in earnouts, and the bite of depreciation recapture.
And the clear message, the single biggest lesson from digging into all this material is that the gap between just selling your business and achieving a truly great after-tax result comes down almost entirely to foresight, strategic planning, and getting the right expert advice early in the process.
You've built something valuable, poured years into it. When you sell, you deserve to keep as much of that value as legally possible. Understanding this tax landscape is the first step.
It's about being proactive, not just reacting when the tax bill arrives.
So let's leave you with a final thought to chew on, based on everything we've covered. Thinking about the specifics of earnout basis recovery, or that difference between equipment and real estate recapture. What specific asset or potential deal term in your business might represent the biggest potential tax surprise down the road? And maybe more importantly, if you haven't started planning, what's the very first concrete step you're going to take now after hearing all this?
Asking those questions is where smart tax planning really begins.
A crucial starting point. This has been a deep dive into a critical topic for every entrepreneur thinking about their exit. Thanks for bringing the sources and joining us on this exploration.
My pleasure. Always important stuff to discuss.
We'll catch you on the next deep dive.